to be trend analysis or identifying a trend. The idea of today's session is really to discuss how do we define a trend? Why is that important? What are some of the different methodologies and considerations? What are some of the limitations? And then most importantly, how useful or how can it be used in a productive manner for traders? The idea is if we can find a trend as soon as possible, we can identify it, trade with it, and hopefully make some money. And of course, manage risk along the way. Now, we do have quite a bit of time here together, folks, for this kind of session. So we definitely want to make good use of it. If you have a stock, an ETF, an option, or some kind of trade on your mind that you'd like us to take a look at and use as an example, go ahead and let us know. Put it in the Q&A, drop a comment or question there. We'll try to keep this as interactive as possible to the best of our ability. Now, in terms of today's agenda, what we have planned is a bunch of different slides we're going to go through. Just depends on how much engagement we get. We might spend a lot of time there. We might spend a little bit of time, but probably 10, 15, 20 minutes on some basic fundamental or foundational content about just trends. Some really nice, clear pictures of what a trend looks like, uptrend, downtrend, sideways trend. And then after that, we're going to just spend time doing some live demonstration using Active Trader Pro, Fidelity.com, what tools do you have available to you as a trader to go and apply some of these concepts? With that being stated here, I don't see any initial questions coming through, Andrew. So I'll pass it over to you to start us off with the basics of trend. Why do we care? Maybe how is this useful to traders? But it's good to see you. It's not 10:30, it's 2:30.
Yeah, 2:30. Not quite sure on that front, but we are late in the afternoon at this point, and like you mentioned, happy to be back with everyone today. If there was anything that I could spend probably hours on, more of a dissertation almost in that respect, it is really just the concept of trend when it comes to the markets in general. If anything, that is the core basis of technical analysis. We go back to its original kind of foundation, the Charles Dow approach, the approach that looking for there to be trends out there in the marketplace. This idea that trends are observable out there in the market, and hopefully that we can take advantage of them, like Chase mentioned. So we'll talk about it through that scholastic lens. We'll look at real-time examples as well, as he mentioned. So you've got us here for the next hour or so. Feel free to ask any questions. This is a live and in studio sort of session, despite Chase saying 10:30. It is 2:30 Eastern time. It is live. It is June 10th. And we'll take a look at things in real time here today. But the main component, like I mentioned earlier, is that the concept of trend is that driving fundamental component of technical analysis is that we base our outlook, base our assumptions, and base our kind of observations on this interaction of buyers and sellers, and this idea that over time we can observe either accumulation taking place within the marketplace or distribution. And a lot of the time, I think where people first, when they begin trading, and of course, if you were kind of a scholastic approach of trading. If you've read the Benjamin Grahams of the world, the Warren Buffetts of the world, of course, the phrase that we will always hear is buy low, sell high. And of course, I am not here to say that that is not the main point of trading. If anything, the main thing I'm wanting to point out is that buy low, sell high has a little bit more nuance than that, because mathematically, that's really the only way one can make money in the open market, is to buy something for lower than what they hopefully can sell it for when it comes that time. What sometimes is that differentiating shift, that paradigm shift that we can find, is that buy low, sell high can also sometimes mean buy high, sell higher. Sometimes the issue with that phrase, buy low, sell high, is it starts to teach us to some degree that the market has some sort of mean reverting tendency to it. And the main thing we want to kind of discuss today is that it doesn't necessarily always have that. There might be mean reversion within kind of a concept of a trend. If you look at some of the major stocks, say over the last 10, 20, 50, however, so many years, you'll notice, of course, there are ebbs and flows and there's ups and downs, but there's generally observable periods of movements up where that mean reversion is taking place, or maybe even movements down where that mean reversion is taking place. So the big thing that we always want to remember is that the market tends to have some sort of trending mechanism. People are either accumulating shares, and when I say people, kind of the market in aggregate, or there's a distribution effect taking place. And of course, that trend's direction is something that we can observe, and that's something that we can make assumptions based off of, because we essentially assume that trends continue rather than reverse. There's a momentum component out there in the marketplace. Does that mean that things can't move and kind of stop their trend at any moment in time? Not by any means. Of course, there are things that can change the general trajectory, but that's also something that we can take advantage of as traders. We can allow a trade to continue to work out, assuming that there is still an uptrend to be found. And that component of momentum being found in the marketplace is something that we can derive our own side of the equation on, this assumption that trends tend to continue rather than reverse. The way I generally like to think about it is that imagine if you were on a boat out in open water. Well, turning a boat around takes a decent amount of momentum, especially when we start thinking about different sizes of boats. Now, of course, if you're on a jet ski, a speedboat, you can turn it around fairly quickly. But, we could start getting into bigger yachts, cruise ships, barges. How hard are those to turn around? That's what we really try to think of when we think of long-term versus short-term trends, that there is a momentum to be found, that something has to really change on the undercurrent of the surface for that trend to start to erode. And that's what we ultimately want to try to find. So, of course, there's really two major types of trends, and you could argue a third type of trend we'll take a look at, of course, but maybe that's a different component here. But essentially, when we're thinking about trend just from a scholastic textbook perspective, we're really just looking for this component of higher highs and higher lows. And of course, it just seems so simple that how could that be mistaken? But that is ultimately what we are looking for. We're looking for a stock, an ETF, an index, or what have you, that is continuing to go up. Why does that happen? Well, it is driven by that supply and demand dynamic of the marketplace. In essence, an excess of demand being found at different points in time. And how do I mean by that? Well, imagine you were a buyer along the bottom left-hand side of this chart, and you were thinking that when we got to, say, this first bubble here, you're probably thinking this, well, hey, I'm a genius. I bought it all the way back here. And if anything, I wish I would have bought more. And that creates a scenario that when we get these pullbacks, it creates this demand of people who either maybe missed this original move that we had here, or maybe they wanted to reload some of these components here, and then we drive it up higher. And the same component can be found that now people who they didn't want to buy it here, they were a little nervous to buy it here, and then they saw it go up again. We start to see this demand component outweighing the supply component along the way up. And that is the main thing that we're looking for in that situation. I see Gary looking at a great question already. Longer trends are easy to see in retrospect. How does one start with a short-term trend? And that's the main thing that we want to kind of discuss here today, is that we can observe different components of trend over periods of time. And how do we actually make trading decisions based off of that? And first, we'll look at it through the lens of kind of an objective break of different trends to this degree. And we'll also try to look at it through the lens of different indicators, because I saw another question come in from someone asking about different types of indicators for trend. If we're thinking about this idea of higher highs and higher lows, how do we know that something has changed in that respect? Well, what if we start to see the opposite of that? What if instead of seeing higher highs and higher lows, we start to see lower highs, we start to see lower lows? This downtrend is also an effective component. Now, does that mean that people have to be long or short at any moment in time? And if there's an uptrend, then we are long. If there's a downtrend, then we are short. Not by any means. But at the very least, the downtrend is a good warning sign if you were long. Then imagine if we can kind of quickly think about the flip between these two slides, that for one moment in time, we were higher highs and higher lows along the way. And then all of a sudden we make a lower high and then another lower low. That is that first kind of undercurrent sign that something has changed along the way, that we were seeing buyers willing to buy at incrementally higher prices. Now we are seeing sellers willing to sell at incrementally lower price. And I'm sure if anyone who's been following markets over a period of time, you can think about different stocks that for a while, it seems like nothing could stop it from keep going up. And then all of a sudden, it just seemed like there weren't any buyers that were willing to buy it anymore. You can really feel that from time to time. It doesn't mean that you'll always know what to do, but it means that we can kind of observe what is happening in the market. And to Gary's question on that as well, that's a big component, I think, of technical analysis, is that unfortunately, when people first hear about technical analysis, they want it to be kind of predictive, that, hey, if this wedge pattern or this an interestingly named pattern happens, well, that means that X thing is going to happen over the next X amount of weeks. And unfortunately, we don't quite have anything quite to that degree, in the sense that we never know what the future is really going to hold. If anything, what I find beneficial about technical analysis is not that it's predictive, it's that it is reactive. It is creating rules and kind of a rule-based system for what we can allow a trade to work out in our favor, versus when we start to see evidence to the contrary. Again, imagine if we had been holding a stock through that uptrend like we had just looked at, that we see this component of higher highs and higher lows, and then all of a sudden, that's no longer the case. All of a sudden, we start to see these downtrend start to beginning to form, that lower high, lower lows, things to that extent. We are now able to potentially exit this trade for sake of risk management, that we are no longer seeing these components of things working out in our favor. And of course, kind of to that question as well, how easy is it in hindsight, and what does it feel like in the real time? Sometimes we don't quite have either of those things happening at any moment in time. We have to remember that the market is not constantly trending in all moments in time. It's not either going up or going down. Sometimes there is mean reversion. Sometimes there is sideways components of the marketplace, or we're just not seeing that defined higher high, higher low sort of relationship. We're seeing a little bit of choppiness. And of course, there's ways that we could hope to profit in the range of a sideways trend. But that's an important distinction, is that sometimes we don't quite get that exact sort of relationship like we're looking at. So there's a few different ways that we can look at these different ones. Of course, a trend line is going to be the first kind of a subjective way that one can look at this chart in particular when it comes to uptrends and downtrends. Essentially, a very simple component of actually just drawing a line on the chart and creating a risk management plan based off of that level in particular. Upward sloping lines, downward sloping lines. I'll show kind of a real-time example of how this could be used in that respect. But again, if we're thinking about the drawing side of the equation, well, we could just connect those actual supportive levels on the chart where we had seen buyers willing to step in at incrementally higher prices. That component of drawing a line essentially at the troughs of these levels along the way, we can see visually that accumulation effect being found in the marketplace. And the same thing can be said on a downward sloping perspective, that we can see when we connect the peaks along the way, this distributive effect that is happening out there in the marketplace as well. We can observe that in real time. And of course, like we've said, this all does seem fairly simple in hindsight, but what if we were looking at a chart in real time? Well, let's look at the S&P 500. In fact, let's go back a couple of years in this respect, that coming out of the COVID timeframe, well, we saw a fairly strong uptrend during that period of time. If you simply connect these levels in particular and then look at the different levels along the way, well, we saw that there was a kind of almost a perfect relationship from a buying perspective at this level in particular until the beginning of 2022. That first break to the downside can be that kind of warning signal that we're kind of referring to. Does that mean that you're ever going to get out at the exact top? Unfortunately, no. That is the trade-off that we take as trend followers. We are not going to time bottoms, and we are not going to time tops. In fact, had you been someone kind of not holding a position at this range in particular, well, sure, it would have felt very good in hindsight to have been a buyer at these lows, say 2191, call it 2200. But there wasn't really a lot of evidence in our favor to be a buyer at that level from a trend-based perspective. Maybe you use other components of trading, but from a trend-based perspective, there wasn't really a reason to be a buyer at that level until we started to create some constructive moves back higher. This first move that we see here, and then a higher low, and then a higher high, a couple of components here start to paint that picture of that now starts to feel a little bit more like accumulation is taking place. And we can see that, essentially for most of the next year and a half. But like I mentioned, what happened at the beginning of 2022, when we start to see a break of that trend line. And then from there, we can really observe that first lower high taking place. Now, let me just make this a daily chart, and we'll zoom in to a couple of these levels in particular, because I think, like we've mentioned so far, there are a few times where, yeah, in hindsight, it looks like easy components of what we were just discussing. But say at this moment in time, I remember this level in particular fairly vividly from a few years ago, because at this time frame, we had just kind of discussed, all right, we broke the major trend line, but we got back above these levels in particular, kind of creating maybe a new higher high in relation to this level. We, of course, had this lower low here, but it's something that started to feel a little bit constructive because we got back above these prior highs, but that was short-lived. In fact, only a few days later, we started to have that move back below, now truly definitively creating a lower high at this moment in time. And again, let's just kind of rewind the clock. If you were someone trading here and you just see a relationship to the right here. In fact, let me remove this line just so we're only looking at the distribution effect and we extend this to the right. Imagine you're just simply waiting to see if we have any sort of relationship here. Well, we got pretty close to testing it here, unable to break through that. So still confirming this overall distribution along the way. And then during this time frame, we are getting lower lows on price as well. And then from here, we start to get back up there. Again, we test right to that level one more time, and then still confirming this idea of a distribution along the way. But you'll notice this next time, what is slightly different about this spot in particular? Well, you'll notice that the main difference is it didn't go back to those prior lows. It created this first, at least, change of paradigms in that respect that we find a little bit of an idea of a higher low. So, of course, we could just simply draw here, get a just general idea of what's happening. And you'll notice this is the first time we break that actual major trend line that we had during that time frame. We come back down and we test it a couple of times, but you'll notice this after this throwback, we start to again create this idea of higher highs and higher lows being found along the way. We can kind of create this trend line here as well. Of course, it then zooms all the way back out for me, but you start to see how these relationships begin to work themselves out along the way, that we see this idea of accumulation taking place and how important that can be from the idea of overall just accumulation being found in the open market. So again, it is hard, of course, at any moment in time when the only thing that we have kind of at that moment is what is happening at this day in time. But ultimately, we can use it as a way of creating an idea of risk management. Imagine, say, during that first period we were looking at, that 5-year time frame going out of COVID, well, maybe we draw a line here and you're thinking, well, hey, I'll continue to be long as we are respecting this idea of trend. And when we break it, if we break it, then I can reevaluate my position. Maybe I just get out of things from that time frame. At the end of the day, what a trend following strategy, at least from the bullish perspective on, say, a long-term name or an index of sorts, is we're trying to avoid those major drawdowns. If we think about it from that lens, is that when we exit out due to a change of trend, we're really just kind of hoping to avoid, quote unquote, the big one. We're wanting to make sure that if it is going to have a move back downwards, that we're just not part of that equation. If it does end up getting back into an idea of an uptrend, then we can then get back into the position. And that's an important distinction of being a retail trader, being a self-directed trader, is that we can be in or out of positions how we see fit, in that sense that just because we got out of a position doesn't mean that we can't get back into that position. And that can just be a simple way of looking at it through that risk management lens, is that we're wanting to continue to see things working out in our favor versus when they are not. There's an often quoted quote from Peter Lynch, a famed Fidelity investor, that the way he tends to kind of refer to this thought process is that we want to treat a trade, a portfolio, things to that extent, kind of like a garden in that respect. That a lot of the times as traders, we tend to cut winners fairly quickly, and we tend to hold on to losers too long because, one, we think, well, hey, we can book profits on this winner. That profit will offset these losses I have, and if those losses end up getting back to break even, well, then I can close it then. But if we're thinking about it through that garden analogy, well, it kind of means that we're at that moment kind of cutting our flowers and watering our weeds. And the, of course, thing that we want to do from a garden perspective is we want to water our flowers, we want to cut our weeds. If we are seeing things that are not working out in our favor, well, we can cut that, manage our risk, and allow other trades to hopefully work out better for us along the way. I know I've been going for a few minutes just on trend itself from a subjective perspective. And of course, we want to take a look at things from a more objective lens. Anything you want to add here, Chase, or anything you want to take a look at next?
Yeah, let's go ahead and talk a little bit more about the length of the trend or the period of time that maybe you're looking at too. It's funny, you were showing the S&P 500 earlier, Andrew. I had the same thing or something quite similar mocked up. But what I've done here is I've highlighted three different areas showing a variety of trends. And this is even just without trend lines, right? We can just kind of use our eyes and understand what's going on here. So entering up into this left side of this box is a bit of an uptrend, right? We got higher highs, higher lows. These subsequent pullbacks or movements to the downside are short-lived and they rally higher. And then over here, we've got a downtrend. Pretty clear, right? We got these lower lows, these lower highs. Each time it's sold off, the rally subsequent to it is actually short-lived. So we can kind of start to get a picture of what does a historical shorter to intermediate term downtrend look like? What does a historical uptrend look like? And so the reason we might look at this as a trader is to say, hey, I'm not trying to predict the future, but if I've seen what the past looks like and the future starts to slowly shape up in a similar way, I can start to put two and two together and make a plan, right? Like let's say some point down the road, we see a chart setup that looks something like this, consistently moving higher. Then we see some volatility. Then we see this reversal with almost like a double top pattern. This almost this pullback into this kind of reversal point, this neckline, if you will, and then a major failure point. As you start to see this, you could really say, hey, I've seen this in the past before. It doesn't work out too well. So maybe I'll manage some risk. But I want to stop with a quick question here, Andrew. As we look at these three different scenarios, two of them being bearish, one of them being bullish, would we say that during this period of time, the market was in an overall uptrend, downtrend, or a sideways trend? Go ahead and put your comment in the Q&A. I'd be curious to see. Do we think overall, like, hey, this is net bearish, net bullish, net neutral? Maybe it's neither. And here's why I bring it up. It's important to keep in mind what time frame we're looking at. This is a maximum time frame chart, but on a monthly frequency. So these candlesticks, they're not days, are they? Andrew, you were showing a daily chart earlier. These are months. So this is years of time. If I zoom out here, right, the little trick that I've devised is that here's the longer term chart. Pretty clearly, it's a long-term bullish uptrend, right? From the 70s all the way till now. But yeah, did we have some volatility in a lot of it in the 2000s? Yeah, sure. Of course we did. Mark, Joseph, Jawar, if I'm saying that correctly, all saying sideways. So yeah, there's some sideways volatility within the overarching longer term uptrend in this case. So it's really, really important to understand what is the context that we're trading when we're trying to define trend. If you're a short-term trader, you may look at this chart just to understand the overall market conditions and then trade within it. But if you're a longer-term trader, this might be the trends that you're trying to look at and analyze. So it's important to know what kind of trader you are, what kind of asset classes you're looking at, what is the time frame that is most interesting to you. If you're someone who doesn't have a ton of time, like Andrew, we talk to these clients who say, hey, I want a reliable trading system, but I don't have time to watch it all day long. Totally get it. But then you're probably by definition not going to be a day trader, right? It's pretty hard to be an intraday trader when you can't watch your computer screen all day. So you might need to find and identify trends on the longer term that you can kind of sit back and relax and watch, right? Versus if you're an intraday trader, you want to be looking at the shorter term time frame. So just kind of match up the tool to what you're trying to accomplish. If you're trying to put a nail in the wall, you want to use a hammer. You want to put a screw in it, maybe a screwdriver, right? Or a drill. So just kind of match that up to what is the most appropriate by time frame. Okay, you mentioned real quickly, Andrew, about being objective. I like that approach, right? Can we try to take some of the art out of this process and be a little bit more scientific? Yes, we absolutely can. So, I think what Andrew was talking about is if you draw a trend line, it's a bit subjective in terms of where you draw it, right? Like, for example, I might connect these peaks together. Okay. And Andrew might only connect these two or three and not include this one. Or you might include this kind of an uptrend right here. But a different trader might draw from this pivot point to this pivot point here, right? And say, hey, more of a macro view, if you will. You can't say either one's really wrong because what we're trying to do with these lines is identify not the trend, but a trend that we're going to use for our decision-making process. That's a bit subjective, right? It just is. So, do we have objective tools? We absolutely do. I was talking to Andrew offline. One of the most commonly utilized tools is a simple moving average. Just by a raise of hands, got a bunch of people in the room here with us. Who's heard of a simple moving average? And I would expect some hands to go up. Yep. Okay. Awesome. Yeah. 10, 15 people. Perfect. So here in Active Trader Pro, we can add a technical indicator. Now, if I take a step back, what is a technical indicator? It's just a mathematical tool that will add a visual aid to your chart to help you make a decision. That's all it is. One of our old teammates on this trading strategy desk group used to say if our brains were supercomputers, we wouldn't need technical indicators because our brains could do it all, but they can't, right? So we're going to add it to our chart by searching the letters SMA for simple moving average. Now, by default, what our system does here at Fidelity is it's going to add a 20 period simple moving average. Let's break it down just real quickly here for those who aren't familiar with what this is. All that this is doing here is the simple average through time. So it's looking at 20 days, averaging all those prices together, and it plots a point. And then with each new day, it gets rid of the oldest one, adds the newest one, it recalculates, and we see a rolling, moving calculation of a 20-day average. That's all we're trying to do here. Now, why is this important? Well, one, we're smoothing out some of the oscillations in price. That can be pretty helpful for traders, especially if there's some noise and volatility. But by definition, it's also now giving us a visual representation of the trend based upon the average, right? This is the average movement over the past 20 days through time. And so oftentimes a trader will use this as a definition or a proxy or a visualization of a trend they may want to trade. So rather than subjectively choosing a trend line as to where to start, this will objectively do the math and plot it on the chart for us. Then the application is relatively similar. If price action is above your moving average, that's bullish, all things being equal. If price action is beneath it, that's bearish, all things being equal. And if you have price action moving up with a inclining simple moving average and is above it, of course, that's going to be the definition of bullishness or bullish price action. If you have a moving average that's curled or pointed down or declining, a negative slope, and if price is also underneath it and going down, that's the picture of bearishness. Now, here's where, again, we're kind of blending the art and the science. The scientific part is the math, right? This is going to do the math for us. No ifs, ands, or about it. But the question is going to become, well, what's the right one to use? What's the right period? Because our system by default puts a 20 period. But what if you don't want a rolling 1 month average? I say 1 month because there's approximately 20 business days per month here. What if you want something a little bit longer term and slower to react? Let's go with an intermediate term time frame, like the 50-day simple moving average, and this is going to be the blue line. Well, notice here, it doesn't oscillate up and down as quickly. It takes more time for that ship to turn, if you will. Why? Because now there's 50 data points being averaged through time, not 20. So it's less sensitive to price updates and movements in the calculation. But clients can still use this as a proxy for trend, but it's just a little bit of a different way to look at it. In addition, we could get rid of the 20 if we wanted to. We can make this a 200. Now we have an intermediate term trend and a longer term trend line. And so the idea here is if you're a longer term or intermediate term trader, you may want these moving averages over a very, very short term whipsawing type moving average. Again, matching up that tool to what we're trying to accomplish here. Anyone ever heard of something called the golden cross or the death cross signal? You ever see an article written about one of those? Just raise your hand or let me know in the comments. Very common. And what they're trying to reference here is if you have a major crossing of the 50-day and the 200, that it provides some kind of signal. So in general terms, if the 50-day, which is a shorter term moving average, crosses up and above the 200, that's regarded as a bullish signal. Like, hey, that shorter to intermediate term trend is really starting to shape upwards and it's breaching and breaking. It's going up and above that longer term, former bearish market condition now becoming bullish. The death cross just being the inverse. So the 50-day moving average crossing down and below the 200. Andrew, my point here, I'll take a pause and pass it back to you as we think about mechanically using these. But my point here is we can scientifically or objectively use these measures to define trend. And from there, we can just react to it. We can't predict what's going to happen, right? Like you were saying earlier, I can't scroll off into the future and see what that blank space is going to show. But I know if price crosses down beneath it, something's changed. Hey, we're bullish because we're above it. But if we go beneath it, by definition, it's not bullish, right? What do you want to add to when we think about moving averages? Do you want to talk about either crossovers or the pros and cons of the different levels of sensitivity? What would be important for a beginner trader to maybe think about these?
Yeah, absolutely. Like we mentioned, there is an objective component to moving averages. Simple moving averages are not the only moving averages. And of course, there are plenty of different ones that traders use. We tend to start with simple moving averages from an educational perspective. One, because they're easy to understand mathematically. The calculation of this is simple, pun intended in that respect, that it is just simple arithmetic. We add up all of the closing values over a defined period. We divide by the period we've selected, a 50 period simple moving average on a daily frequency like Chase has here. That is a 50-day moving average. In essence, the price average over the last 50 days of time frame. So if the price at that moment in time is higher than its 50-day moving average, well, mathematically, objectively, price is higher over the last 50 days. That is what we're trying to ascertain to some degree. And over longer term versus shorter term timeframes, it's going to give us a more objective idea of what the trend is during that moment in time. So a variety of different ways in a strong trending environment, you'll kind of see all of the trends working in their own separate way. You'll see on this one in particular, there's 50 and 200, both kind of rising in a very similar slope, just a little bit more of a gap between one another because the 200-day has lower prices on a longer term time frame that it's looking at. So from a trading perspective, like we mentioned, the first lens of that is this idea of support and resistance at these levels depending on distribution or accumulation. You'll notice kind of on the left-hand side here, where were there a handful of bounces at on the Amazon chart kind of inexplicably right at that 50-day moving average? Is there a reason from a fundamental perspective that something happened that day in particular? Was the price to earnings ratio perfectly at that 50-day moving average? Not likely. It is just simply that buyers were willing to buy it at this 50-day moving average because that had been an area of support over a defined period of time. Now, if that changes, maybe they're willing to exit their position. And that's the important thing to remember as a technical trader, that the idea of validation versus invalidation of a trading thesis is something that we're looking for at all moments in time. And so that discipline that's kind of required in the sense that, well, hey, if I'm no longer getting this validating component of my thesis, well, I can just exit the trade, wait for there to be better opportunities from that perspective. And sometimes that's a hard needle to thread for some people who maybe prefer to be longer term traders. But even in that scenario, I would kind of liken us to the fact that we can always bring up longer term components of that trending perspective. So say if we go back to that S&P 500 example on a simple moving average basis. Well, over the last year, we can find a few different areas of support and resistance. It seems for most of this trend that we had coming out of the end of 2023, that 20-day moving average was that main concept of support. We did breach below it here, but since we've got back above it, we haven't really closed below it since then. That has been a major component of support over the last year or so. What if instead of a daily perspective, though, we switch to a weekly perspective? Well, so happens that 20-week moving average, do you remember me talking about that uptrend that we had during that post-COVID timeframe? Where I drew that trend line on the prior example was basically exactly at, inexplicably, that 20-week moving average. Buyers were willing to buy on that uptrend, and then as we broke out of it, it became more of a resistance, and that became that distribution effect. Or the same can be said, where do we find an exact bottom during that drawdown of 2022? Maybe not quite exact, but it was at a 200-week moving average. Same thing can almost be said from the COVID perspective. So even if you are a longer term trader, maybe we can just use this as a way of managing risk. That, again, what I tend to liken a lot of trend following to, especially on something that you would prefer to be in more often than not, but you want to avoid some of the major drawdowns. Well, by having some sort of lens of that trend at any moment in time, we can allow ourselves to get out of a stock, ETF, index, or what have you, to avoid further distributions. Imagine if you were simply looking at someone trading strictly off that 50-week moving average, for example. Well, for most of, you can kind of see in 2015 to 2018, you didn't really need to get out of the S&P 500 at all until we got to that 2018 drawdown that we had for a bit of time. And during that 2018 drawdown, let me zoom back out here, that 2018 drawdown that we see here, well, it broke below that 50-day moving average. Maybe you exited just to wait to see what happened during that time frame. We got pretty close to that 200-week moving average, and then you could just simply be back in when we got above the 50-week. And we saw a few more years without testing that. That first week of the COVID drawdown, you could have been exited and moved into cash to avoid this next 25%. Now, does that mean that you caught the bottom? No, it means that you were probably in cash during this time frame, watching other people worry about that downside. And then when it got back above that level, that in particular, you could be a buyer again. We didn't get back below that for another 2 years. And that same component that maybe you missed out on this distribution and then got back in somewhere around what's look like probably about 4,000 on the S&P 500. And then we've been in that effectively since the bottom of 2022, or not quite the bottom, but when that first constructive move out of the bottom got us back above that. So sometimes it can just simply be that green light or red light on a longer term trade. And even from that perspective of, say, a monthly time frame, that 50-month moving average, all of the downtrends for the most part were caught within that time frame. Imagine we go back to that example that Chase was looking at, 2000 and 2008. Imagine if you got out somewhere around that, say, 50-month moving average, a very long-term trend that doesn't get broached too often. Well, of course, that was a pretty decent haircut from a drawdown all-time highs perspective. You watch your portfolio lose, say, 20% of its value, but you avoided the next, what is this, 30%. You didn't have another continued drawdown of 30%. And then when you got back in, let's see what this first breach was, 1100 or so. You got back in roughly around where you got out of it, watched another 10, 20% in your favor, and then did essentially the same thing. You got out right before this major drawdown of the 2008 timeframe, waited to get back in until we were back above that. Those longer term trends can still work out from that perspective. In fact, other big names, we can see that being the case here as well. What has been supported for Apple since effectively the 2000s? That 50-month moving average, that longer term component of an objective level of trend, has not really been broached, save a couple of points during 2008, where you may have been out of it for a month or two. And again, the main reason we want to have some sort of component of this is that it's easy to look at these major names. Amazon, I think, is always such a good example of this, is that you'll often hear this phrase that during 2000, Amazon lost, was this 95%. And then from that moment, it has gone on to make, what is this, 58,000%. So everyone will always say, well, if you had just bought in the lows of 2000s, you would be up, such a significant number in that respect. But what would have been the reason for buying something that low? Because we have to remember, we only know Amazon now as a major component of what we now do on a day-to-day basis because of what they've been able to do over the last 20 years. In 2000, you probably just simply thought this was another .com bookstore that didn't get it together and didn't make it work. Because think of how many companies did this first part of what Amazon did, lost 90, 95%, and then never recovered. They don't exist anymore. They got acquired. They went out of business. How many .com companies can we think of that were the hot thing for a brief moment and then just simply went out of business? That's the main thing we're trying to avoid as trend following traders, because if we think about all of those components, that there's what's called a survivorship bias sometimes out there in the marketplace, that we think that because Amazon fell 95%, or other names have fallen 90, 95%, that this one who has recently fallen 90, 95% is the next one that's going to recover all of that. But a lot of the times these companies don't recover. I want to say, I can't remember this is the exact number, so forgive me if it is not, but I want to say roughly 90% of companies over their entire lifetime underperform T-bills in the sense of a risk perspective, that they end up not panning out from a company perspective. They end up being acquired for much lower than they went public for, or maybe they even go out of business along that period of time. I don't mean to kind of pick on a name in particular, but one that we use on a day-to-day basis, Zoom. Imagine if you were looking at this chart in particular, Zoom, from the moment it went public, it was roughly about 60 or so dollars, 65-ish. It went up all the way up to roughly $600, call it a 10x trade. And now, after we went from barely using Zoom at all to using it daily for most people in kind of corporations and things to that extent, we're now trading effectively below what it went public at. Does that mean that you couldn't have taken advantage of some of these trends along the way? Well, imagine if you were able to ride up most of this concept of trend. Maybe you're just wanting to hold a 20-week moving average, 5-week moving average, something very simple. And maybe you got out somewhere along this way. Well, again, you didn't actually tick the exact top. That is a risk we are going to have to be willing to take, is that we are not going to find the exact top by simply using trend following strategies. But imagine if we could have got out $300, $400 and then not have to see it move all the way back down to 60. Can this recover and go back to 600? Unfortunately, we don't know. We don't know what the future holds for these names in particular, but we can at least have a reactive risk management plan in mind. Because without that, how do we kind of ascertain what we are going to do with this name in particular? The main thing I always want to make sure that people avoid is what I tend to call the Yosemite Sam strategy. So, of course, if you remember the Looney Tunes time of frame, and you would see Yosemite Sam kind of dare Bugs Bunny not to cross a line, and then when he did, he would draw a new line to dare Bugs Bunny not to cross that one, and do that over and over, draw lines and not draw lines, and then all of a sudden Yosemite Sam falls off a cliff. That is what we are trying to avoid as traders. We are wanting to make sure that, say, if you were someone, well, hey, I bought it at $500, but as long as it holds above 400, I feel okay about it. And then all of a sudden it's at 300 and you're thinking, well, if it holds above 250, I still feel pretty good. And all of a sudden it just has kept going down. That distribution effect, like we mentioned earlier, is an important thing, that is a driving force of market dynamics, accumulation and distribution. Is there a phase? Is it a short-term distribution, or is it a new paradigm shift? And of course, maybe during these first few moves, you were thinking, well, yeah, it's got to cool off. It just went up 10x in such a short period of time, but it didn't keep going up. It started to have those lower lows, like we've mentioned. Of course, a recent name in that respect, NVIDIA, it has had a very significant move to the higher side. It's so weird now to see it in its split adjusted price, 121, been used to the 1200s or so in that respect. But again, imagine if you were trying to look at it through this lens on a weekly moving average perspective, some sort of lens of a risk management. What is it not really broken below since the end of 2022? A 20-week moving average. Call it maybe 1 or 2 weeks that it tested a 20-week moving average. If you had just been someone saying, I'll hold this if it's above the 1 week or the 20-week moving average, well, you last bought it at split adjusted $15 and you've held it to 120. And maybe you got out of it during this break, and maybe this break, or not this one, but this break in particular, that maybe you got out of it after it tripled in value, and then the next couple weeks got back into it. Well, then you've watched it double in value since then. It is a way of just creating a risk management plan that I'm say you're willing to be above it or in this position if it's above a certain component of trend. And if it's not, then I'm just willing to wait on the sidelines until things look a little bit better for this name. There's a variety of different ways that people use these moving averages. It does not have to be as simple as long if it's above X moving average, not long if it is not, but it's a way of objectively seeing that there's some sort of prevailing wind in the favor of the long trader when we see this kind of component of trend working out in that specific way. Let me change this to a logarithmic chart just so things can be found a little bit better here. But you'll notice that during this time frame, and again, once we got above it from 2022, it's kind of been off to the races. I mean, monthly perspective, we've seen similar components here, that it has not broken below a 50-month moving average. Say you've been trading it since the early 2010s, then you've been able to hold it simply on that basis from 37 cents, it looks like here. And then, of course, there was plenty of times where you suffered larger drawdowns, and that's the trade-off you have to be willing to make if you are going to use longer term components of trend. That for it to even test a 50-month moving average here, what did it have to fall? It had to fall nearly 50%, or say this time frame in 2022, I think it fell even more than that. Yeah, about 60%. So of course, you have to be able to stomach a little bit larger drawdowns if you're going to use a longer term component of trend. But it at least gives us a way to manage our risk. Again, the way I like to mention it is, if we're going to be holding something for the long term, it's an investment, have some sort of lens in mind that helps us just simply to avoid the quote unquote the big one, in the sense that it move that is large enough that it's very unlikely for it to come back from. Because again, if we think about something that has fallen 90%, what does it need to get back to break even? It needs to go up roughly 1,000%. That's a large hurdle for a lot of names to be able to do. And it doesn't mean that it can't be done. It just means that if you're holding something that's down 90%, it takes quite a bit of momentum change and the market's approach to that name changing for it to get back simply just to your break even price. And the main role really of the trader is to be a risk manager, live to fight another day, live to look at other opportunities that are out there, have idea of an opportunity cost. If I'm losing money on this name, could I be making money on something else? And yet I'm still holding this name that from an objective lens, I can't find a bullish thesis for. No, we're already towards the tail end of today, though. Anything that you wanted to add as well there, Chase, before we start to wrap up?
Yeah, there's a few questions I did want to just cover real quickly here that came through the queue. So there's a question about how does one view a gap in an uptrend or downtrend and what action should be taken? Yeah, that's an interesting question. I actually I want to switch gears to a different company here. I'll steal the screen for a moment, Andrew. This is going to be Amazon. So I guess we already had Amazon pulled up, no problem. But something like this is a lot of the concern, I think, for traders, especially like um, if you're using a trend following system, which is something like this, right? You have this, sometimes they're referred to as like an island gap or island type pricing, which is it's a gap that's associated with very far away from price and doesn't really seem to be uh, like relative or meaningful in that it just very quickly reverses, right? Like if we took an average of price through this period of time, this is kind of the outlier. So to the point that is being asked, you're like, hey, what if I'm using a trend following system and then there's a gap, let's say in a trend, maybe that causes me to get out of a position. Like, is there any way around it? And the short answer is not really. That's part of being a trend trader, is that if we think about this in real time, or if we were to walk this forward as if it was real time, right? You have this very, very strong uptrend confirmation at this pivot point that the market, for whatever reason, we can't say why, we don't know, but the market seems to respect the 50-day simple moving average. Awesome. Okay, cool. Bulls are happy, things are moving upwards. And then we start to walk this forward. You see it pull back, and you're thinking to yourself, if you're a bullish trader, hey, this is going to bounce right off the 50. Why? Because the assumption from a technical trader and someone who's a trend trader is that trends will persist until they don't, and that former support will continue to be support until it's not. Well, we keep walking it forward, and there we go. We get one break. You say, nah, I'm going to hold for additional confirmation. Next day, we're right on top of the line. Okay. And then so at this point, if we start to fast forward, we're kind of oscillating around it. And here it is at close just beneath it. If you're super disciplined, you probably closed out. But if you said, hey, it's not a meaningful close beneath it, maybe I need some more confirmation, you get this gap and you say, uh-oh, like here's an extreme downtrend that's developed. It's breaking to 50. It's in sort of a no man's land territory. Let me close my position, right? Then what happens the next day, Andrew? Like always, we close the position to manage risk. What does it do to us? Pops right back up, doesn't it? That's the way of being a trader. But that's just part of the game. And that's just one of the trade-offs when it comes to being a trend follower and trend trading systems. They're not going to be perfect, right? The idea here is not to be perfect. It's to be good enough. Like, hey, if I entered here and I ended up closing out here and I kind of got shaken out because I thought, you know what, looks like a downtrend might be developing. That's okay. Because if I still draw from here to here, and even if you go out at the low of the day, you still made 14, 15%, assuming you bought stock. Now, if you're an options trader, depending on expiration and strike selection, that could be significantly more or less. If you close out at the top of the day or near the close, it's about 20%. So when it comes to gaps, they're unavoidable. They're going to happen in price. Some stocks can do it more than others. Fundamental events such as earnings tend to be the main catalyst for said gaps. If they're going to be like a breakaway gap, breakout gap, run, there's all these different terms for different gaps. But the point is, earnings can often be a contributor. FOMC announcements, product releases, but we're looking at all of that through the lens of the technical chart to make our decisions. So how do you avoid them? You really can't. How do you manage them? Efficiently, closely, and disciplined manner. If it gaps down and you say, hey, in case this now is becoming this kind of trend, right? I wouldn't blame a trader for thinking like, hey, look, we're starting to move down. We've broken the 5 once, or the 50, excuse me, once. We retested. We're stalling up here at this descending trend line. We get a breakout. Okay, is it going to sustain? It doesn't. Oh, it must have been a false breakout. And then we get this candle here I'm just going to close. This is not the picture of strength that I was looking for, right? This kind of pulled back is not the same as we were seeing maybe right here in terms of its size. So I close out. There's nothing wrong with that. We can't blame you for it. You just want to manage risk. What I will point out, and this is something that you mentioned earlier, Andrew, which is if the position reverses, right? So we closed out, we managed risk. Awesome. Good job. And then the very next day, it gaps right back up. What can we do? We can re-enter, right? Because our criteria originally was, hey, I want to be in a bullish position as long as price is above the 50. Well, guess what? It's back above it. Now, you might want some additional confirmation to make sure you don't get whipsawed. So you wait an additional day. Even though it's a red candle, it's still above the 50-day moving average. So you enter here. What happens? Uh-oh, some whipsaw with the next earnings, right? So we want to be mindful of what events we're trading around. And if we kind of fast forward through time, what happens? Well, we end up moving forward. We move a little bit away from it. We kind of come back to it. There's almost a magnetism to it. And you can see most recently we've traded underneath it and kind of back up and above. So the main trend, or this 50-day, if you're using it as your main proxy or determinant of trend, was uptrend. Now it's sort of leveling off, if you will, right? Was an uptrend, starting to go sideways, kind of up, leveling off again, maybe a slight inclination to it here. But you get the gist. This current market dynamic is just simply different. And that's what the trend line is showing us. So if you close on the gap, that happens. Managing risk, as Andrew was saying, is definitely going to be most important. No doubt about it. There was a question about, this came from Joseph. The percentage at the end of the line, is that automatic or do you have to add it? Yeah, Joseph, that's going to be automatic. So if I draw from, let's say, right here to start, wherever the line ends, it's going to do the math for you in terms of percentages. So that will happen automatically. If you left click, hold, drag, and release, it's doing the math no matter where I release this to tell you. So yeah, you shouldn't have to do anything specific there. Just draw the line. And for anyone who maybe missed how we're drawing these trend lines at the beginning, you click draw, you go to the trend line. I call it the barbell icon. Looks like a barbell to me. And you just left click on this once. Your mouse will change to have that icon underneath it. And then you left click once, hold, drag, and release. So that's how you do the trend line. Okay, NG was saying on the Amazon chart, my two moving averages are crossing. Does this mean anything? Yeah, NG, can you just go ahead and comment which moving averages you have? That's going to be important. Like for the demonstration for today, I've been using the 50 and the 200, and we're on a daily frequency. Not to confuse anybody, but we could change this frequency from daily to weekly, which not only is going to, from a visual perspective, change our lines, from a mathematical perspective, from an objective perspective, they're different now as well. Because it's not using 50 days to average, it's using 50 weeks to average on the blue line. And the 200 is a 200 weekly average. So your frequency, and this is really going to hold true for all the technical indicators that we ever really talk about here on this desk, your frequency is absolutely going to be crucial. Okay, so just be mindful. If you're looking at a daily chart, those moving averages are daily moving averages. There's a concept in technical analysis called fractal, or the fractality or fractal nature, which is that we can apply these concepts in the short periods of time and the longer periods of time. So you could be on an intraday chart. Let's go to like a 2-day, 15-minute view. We'll make it a little bit shorter. We'll make it 5 minutes. Let's try that. Okay, better. So we still have these lines here, but this isn't our daily line. This is a 50, 15, or 5-minute line, and this is a 200 period 5-minute. Okay, so we're obviously taking a very different inputs to calculate these. So you might be a short-term trader. That's perfectly fine. You can still use these moving averages, these crossovers, these depictions of trend, if you will, but they're just not the daily trend lines. As a rule of thumb, if you hear any financial pundit, even including ourselves, talking about moving averages, they tend to be referencing the daily frequency charts, not intraday. As a quick side note, though, just to display this concept here, Andrew, let's go ahead and remove the 200 for a moment. Wouldn't you notice? And again, I'm just kind of doing this by happenstance, but this is a 50 period on a 5-minute. Look where price happens to essentially interact among this uptrend each time it starts to stall. Where does it find support? Well, almost always, in this case, most recently, the 50 period 5-minute moving average. Okay. So support here, we see it here, this section here, 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 until recently. Remember, trends will persist until they don't. So at this pullback, a trader who's a short-term trader might have said, hey, look, listen, this should hit and then bounce. And guess what? It did the opposite. So what do? You close, right? Then you say, okay, maybe I flip to a bearish position. Oh, now we're back up and above. Okay, I'll re-enter long. Oh, there's the support. Okay, that's confirmation the market's respecting it. Here's an intraday short-term flag. Oh, it's respected again. You're getting that confirmation of this trend all throughout this trade or prospective trade. And again, when it doesn't respect it, the one time out of, let's say, 5 or 6, that's okay. You just close. You just manage risk. But yeah, you can use that on an intraday time frame as well. And I'm not seeing, Andrew, did NG mention the time frame that they were using or the periods?
Didn't see anything come in, but I know we're right at time, so we'll kind of talk to a few more questions that came in as well. Because
Sure.
a good one from Mark came in. Can you explain why someone would use the exponential moving average as opposed to this one? It's going to depend on a variety of different things. In fact, I do want to mention, we only talked about the simple moving average today, but I will be back. I believe it's if not next week, maybe it's the week after. Let me double check what the time frame is. Yeah, so it is the Tuesday the 25th at 10:30 a.m. We'll be doing a moving averages class dedicated to the variety of different moving averages. I would say SMA and EMA tend to be those first two. The only difference, the major difference here is that, again, if we think about what is the calculation of a simple moving average, it is adding up all of those closes of whatever time frame we've looked at and then dividing it simply by that period that we're looking at. 20 periods, 50 periods, 200 periods, what have you. And the issue that some traders thought about that back in the day was that, well, hey, and that means that we are weighting every single day's close in the exact same way. 200 days worth of information, then each day represents a 0.5% of the relationship of this moving average. Well, what about if something has happened more recent? What if we could weigh it a little bit more? And that's all that EMA is really doing, is that instead of using it from a strictly linear arithmetic perspective and dividing it evenly, it gives a little bit more weight to the recent price action. Of course, the calculation for that is a lot more complicated to be able to do that, but that's the main thing it's doing, is it's weighing more recent price action a little bit heavier than compared to just all of them the exact same. And the hope with that is that in that scenario, it would react quicker to quicker, most recent price action moves. You can kind of see that happening on this Amazon chart in particular. The difference, and what I find people kind of discussing what is better or worse and what they prefer, is that it kind of depends on, are we using it as simply a proxy of trend, this idea of an output from an objective lens of what the trend is doing, or are we using it from this idea of support and resistance? In fact, if you don't mind, Chase, if you could look at the S&P 500 with a 200, actually, let me just save you from having to listen to me just direct you everything here to do on this one, and I'll just pull up my chart in particular on it. The main thing is that the question becomes, which one has more eyeballs? If we're looking at it through the lens of, is it going to have more of a reaction at a specific level in particular? Well, the one that has more eyeballs is going to have sometimes that relationship in particular. And I'll add a 200 period EMA to kind of illustrate my point here, that this move in particular back in 2022, this day, you'll notice that we perfectly tested the idea of resistance at a 200-day moving average. I mean, to the penny. It couldn't have been more flawless from a perspective of resistance at a 200-day moving average. We had tested and gapped above a 200-period EMA a few days beforehand. Does that mean that the EMA was wrong? Not by any means. It just means that there were more eyeballs looking at that 200-day simple moving average. So there was enough sellers waiting at that level in particular that they were willing to take something off the table, wait to see if the market could break above the 200-day moving average, where there wasn't quite that on the EMA in particular. You'll notice that on the EMA is that maybe that was another component of risk invalidation, that people were willing to buy above that. And when we got back below it, they sold it off fairly quickly. Both of these have validity in that respect, but I tend to gravitate personally more to simple moving averages on broader names, on broader time frames, generally just because they have more eyeballs, in the sense that EMAs tend to at least have the eyeballs of most traders out there and people who are very technically oriented, but even people who aren't. I've talked to people who are as fundamental traders as they can be, and they still generally will have a 200-day moving average on their chart, because that's just a way of understanding the general market dynamics at that moment in time. So if there's more eyeballs, I would say, on something, that kind of chicken or the egg environment starts to become the component? Is that where the market turned because that's the 200-day moving average, or is that where the market turned because that's where sellers are looking at the 200-day moving average, thinking that's where other traders are going to be positioning themselves? That is a component. The question I just saw you mention is any idea which are the algos? I think it just depends on time frames. I would say on more granular timeframes, the EMAs tend to have a little bit better of a component of what we're looking at here. Let's just say if we throw on a EMA for today in particular, I know one that tends to be off quoted. You'll notice, I mean, a 20 period EMA on a 1 minute time frame has been fairly component of what we've seen throughout the day. Say if we look at a 5 minute time frame, I know some people tend to look at a 6 period EMA in particular. Let's see how that one's done again. You can kind of see where that's been an important distinction along the way. I think it just depends on the variety of different computers and algos out there. And there's not, kind of the algos, if that makes sense. There's dozens, if not hundreds, of different computer systems all tracking different things throughout the day, all positioning themselves on a variety of different narratives. So always fun, you kind of thinking about it through that lens. But I know we're right at time. Anything that you wanted to add before we wrap up here, Chase?
Yeah, I know we spent a lot of time talking about the moving averages, and it seemed like most people hadn't really had a lot of experience with them. I always do try to provide some additional resources for our clients, so let's do that real quickly here. For anyone who wants to be more confident in their understanding of what those are, how to delineate between the two, SMA versus EMA. So on Fidelity.com, some next steps, all free, might as well take advantage of it. Is the news and research, and then go down to the learn section. This is our learning center. We have all kinds of free content. Of course, you probably know that because you had to go there to register for the session. But specifically, once we're in here, if we click on topics off to the left side, and then we click on advanced trading, or we hover over it, there's going to be a section called technical indicator guide. This is actually fantastic. When I first started at Fidelity, almost a decade ago, right? And I was like learning about these different indicators. I would just spend my time on lunch scrolling through here, trying to read about, one or two indicators a day if I could, and just try to get some exposure to them. So when it comes to an EMA, we have an article here. I'll open this in a new tab. You can read through this. It's going to give you some examples. It's going to compare an EMA to an SMA. These are really good, pretty simple, but useful to take a look at. And for anyone who likes the details, I don't blame you. There is a calculation at the bottom that describes the EMA, which is probably a little bit more complicated, of course, than the SMA. If I scroll through here, it is alphabetical. So the S's should have the SMA right here. Perfect, no problem. We can add that to our chart as well. I guess my final thought here, Andrew, is there's many different ways to determine and define trend. Today was really just a journey and an explanation of some of the more common ways that traders do this. So whether it's an EMA, whether it's an SMA, the idea is we're trying to look at price and determine trend of price so that we can ultimately decide, hey, if things are in a downtrend, do I really want to take a bullish position? Likely not. If things are in an uptrend, do I want to take a bearish position? Probably not, right? Like, let me go ahead and trade with the trend. The trend is your friend. Like, why swim against the current? Let that help to propel your trade and be successful. Are those trends going to end at some point? They're going to. Is that going to be a bummer? Probably, but we'll just manage risk. We'll take the profits as they come so we can continue trading into the future. Andrew, that's everything I've got here for trend analysis. Again, this is probably the biggest and the most core pillar, if you will, of technicals. We could spend here all day long talking about trend, and we probably would if we could. But I would say to our clients, stay tuned for future sessions or in all the different sessions that we talk about trend. You'll start to like look in those sessions and realize, oh, hey, they're talking about trend again and again and again. There's a reason for it. It's so crucial. But Andrew, I see you coming off mute, so I'll pass it back to you for maybe final thoughts.
A lot of great things there. Great place to end it. Like we mentioned, trend tends to be that first and foremost primary component of technical analysis. We look at other indicators, momentum and volume and volatility, things to that extent. But trend tends to be that primary first component. What is the prevailing trend at this moment in time? Up or down? Is it sideways? Understanding that, and then looking at the other gauges out there to take a look at it through that lens. So always important to keep an eye out on that. In fact, too, I mentioned the simple moving average or the moving average class that's not that's upcoming, but we also have technical analysis classrooms that are starting really kind of this week in particular, that last week maybe as well. Look at it through the lens of a basics component of technical analysis. Let me double check what days those are on. Those are on Thursdays of this month at 2:30. It looks like this Next week will be still kind of a similar component of what we went on today, but then next week, to Thursday at 2:30, that'll be on the 20th. That'll take a look at things through the lens of indicators in particular. So again, appreciate everyone joining us here today. We've got a afternoon market briefing to wrap the day up at 4 o'clock. If you want to see someone kind of look at technical analysis in live fashion and evaluate charts and tickers that are requested, that is what we do in the afternoon market briefing, as well as recap the news of the day in particular. And that's every day at 4 o'clock Eastern time. So again, appreciate everyone joining us here as always. Look forward to seeing everyone in these future sessions. Hope everyone has a great rest of their day. Take care.